What I want to do today, I think the format is we have an hour together, and so let me go through some research that I'm currently involved with for 45 minutes or so, and then we'll have time for some questions about what we talk about here or anything else for that matter to fill up the rest of the hour. The title of the presentation is Staying the Course, the Role of Investment Style Consistency in the Performance of Mutual Funds. And I want to, if I may, acknowledge the fact that this is research in progress. It's a working paper that I've produced with two other colleagues. One, Van Harlow, is a MBA and PhD graduate of the university who's been at Fidelity Investments as a senior executive for a number of years. And then also Hanjiang Zhang, who is finished with her PhD but is back taking extra courses and is about to launch her career as well. I don't have a copy of the paper with me. I would suggest that I not burden you with too much paper. But if you'd like a copy, you can go to my website and go to the working paper section and download it if you want to follow up on what we talk about here. I thought what might be useful for us this evening, especially since this is the first presentation, I don't recognize most of you. I do recognize a few of you, and so you may not have seen a lot of these issues before or thought a lot about what research is in a university like the University of Texas. As a professor at the university, I wear two hats. Most of the time you're only going to see one of those hats, and that's when I'm standing in front of you in a classroom. The other hat is the research side of things. And so let me, if I may, give you kind of the big picture of what research represents in finance and where this particular project fits in, and then we'll get into more specifics about what I'm doing in particular with my co-authors. As you undoubtedly know, what we're talking about when we're talking about finance is essentially either investing or raising capital and the financial securities that underlie all of that. So if we think of something as simple as, this is kind of a simplified view of it, but I think it might be useful to place what we're going to talk about tonight. If we think about a financial asset such as a share of stock, there is somebody who wants to buy that stock as an investment, and there is someone else who wants to issue that share of stock as a way of raising capital to run their business. Accordingly, one of the terms that you're going to hear a lot, or you've heard already, or you will hear in the future, depending on where you are in your programs, is the idea of buy-side or sell-side research. So the most fundamental way of thinking about research in finance is, are we asking questions that concentrate on the problems that investors would be concerned with, the people who are buying the stock, and accordingly we call that buy-side research, or in general we're looking at investment management issues. And those would be things primarily are investors, are markets efficient? You've talked about market efficiency at some point in your lives already, I'm sure. And that ultimately is an investment management question. Do people react appropriately to new information in terms of how they set security prices? Are there superior investors? Are there investors capable of beating the market, of generating consistently returns that are beyond expectations according to a model such as the capital asset pricing model or a multi-factor model, an arbitrage pricing theory type of arrangement? Those are buy-side questions. We also have a branch of research in finance that looks at what we call sell-side questions. If a company is trying to raise money, are they better off doing that with debt, issuing bonds, or should they take on new owners? Should they issue new stock? That's what's generally called the capital structure decision. What are the incentives of the managers that we hire to run the corporations? Are they aligned with the incentives of the owners? Those are agency problems. Broadly speaking, those are what we call sell-side research questions. And then we also have financial institutions, the commercial banks, the investment banks, the institutional investors like endowment funds and mutual funds that represent either the buyers or the sellers of those financial securities. So those are the three main areas, and if you think about it, the classes you're going to have in finance follow those lines. You'll have investments classes, you'll have corporate finance classes, and then you'll have classes that kind of specialize in looking at the institutional or the market structure where everybody comes together. And that's the way research works as well. All right, and beyond that then, in any of those specific topic areas, our research can be either theoretical in nature. In other words, we're trying to build mathematical models in the hope of explaining what goes on out there in life. You know, we distill the essence of a very messy world into a simplified framework that allows us to make accurate predictions about what's going to happen if certain policies are invoked or certain actions are taken by investors or corporations. And then we also have empirical research, which is kind of a fancy word for just looking at the data and seeing whether our theories make any sense at all, seeing whether life actually works the way we've predicted it that it will. One thing we have in finance that's a huge advantage over other disciplines is we have a lot of data. You know, people can be stupid in lots of ways, but when it comes to their money, they tend to at least keep pretty good records. So we have you know, century of stock returns on a daily basis on up. You know, when we're looking at compensation contracts, we have very accurate records. And so a lot of the research in finance tends to be, at some level at least, empirically based. You know, we're using the data to actually look at theories or at least notions of how life works to see if they hold true. So in my particular area, my specialty is in terms of research, is looking at empirical issues on the buy side in terms of investment management. And so one of the kind of burning questions that we spend a lot of time thinking about in empirical investment management is this idea of whether investors can repeatedly generate superior performance. Can we actually, as investors, outdo index funds? You know, can we do better than benchmarks such as the Standard & Poor's 500? And then, if there are such investors that walk among us, those superior few, can those of us who are going to be hiring them find out in advance who those superior investors are and you know, pay them accordingly? So the whole idea of whether superior management even exists, and if so, can investors identify in advance who the superior ones are, you know, consumes a lot of time and ultimately is the subject of the paper we're going to look at tonight. So sometimes that whole process that I've just described is captured by the term active versus passive. So when you hear passive in the context, you may have heard passive in lots of contexts in your lives, but in investing, what passive is going to mean is that we can't beat the market, so let's just go ahead and buy an index fund. Let's settle on an appropriate asset allocation that has a risk level that we're comfortable with, and then we'll just go along for the ride. We're not going to try to outperform other investors by picking stocks that we think are better, by rotating our assets from stocks to bonds when we think stocks will outperform bonds. We're simply going to invest in the market and then put it in the lockbox and then just kind of go for the ride. You know, that's passive investing. Sometimes you'll hear it referred to as indexed investing. Active, on the other hand, is an attempt to generate returns that are every bit what you would get as a passive investor, and then something else, then something extra. So the whole idea of active investing is to beat the passive investor. And of course that relies on, at least in principle, the idea that we know something better or different than the rest of the people in the market that we can exploit to generate returns. So, one of the things that we see is very important when we're trying to establish whether we have superior investors is we have to understand what the mandate for the investor was to begin with. If you, again, I don't know where you all are in the program, but you know, for primarily those who are kind of new to all this, one thing you learn very quickly in finance is that we absolutely can't say anything at all intelligent by simply looking at the returns that a manager produces alone. Because returns and risk are connected, and we have to put the two together in some fashion. So the idea in kind of broad brush strokes would be the following. We couldn't look at the returns to a bond manager. By the way, does everyone know where treasury rates are at the short end of the yield curve right now? They're effectively zero. You know, if you were to buy a treasury bill right now, you're effectively making an interest-free loan to the U.S. government. All right, so if your charge as a manager was to manage a short-term bond fund specializing in government paper, you know, T-bills, then if you earn anything above zero, that's a good return. It wouldn't be fair to compare your returns to those of a stock investor. Stocks are far riskier. Over time, they should earn higher returns, right? So the idea is we can't really even approach this idea of what is a superior investor without understanding fairly explicitly what's the mandate that investor faces. And so what I want to do tonight is concentrate just on stock investors, just to kind of narrow the field a little bit. So no bonds, no options, no real estate, no private equity, just public stocks, all right? We're going to look at mutual funds in particular. What we've seen over the last few years is it's very fashionable to define the investment mandate that a portfolio manager is asked to compete in two dimensions. The so-called market capitalization, which is, again, fancy language for the size of the stock, the size of the firm. And we usually define that in three different subdivisions: large and small, and then mid-cap. If you've heard words like large cap, mid-cap, and small cap, we're referring to the size of the company. And then accordingly, on a composite level, the portfolio that we're looking at, what sort of firm represents that portfolio? Is it mostly large stocks, small stocks, or what? And then the second dimension is the relative valuation. You know, said a little plainly, is the stock in question, does it appear to be cheap or does it appear to be expensive? This gets a little fuzzy, and accordingly we're going to use words like value and growth, and then what goes in the middle is sometimes just referred to as blend, you know, a blend of value and growth. And the idea is a little bit hazier than it is with market capitalization, but generally speaking, we're going to use a statistic such as a price-earnings ratio or a price-to-book ratio to get a sense of whether the stock in question is expensive relative to, say, $1 of earnings. Are you paying $15 per dollar of earnings, a P/E ratio of 15, or are you paying 10, or are you paying 30? Value stocks are going to be the ones that have the lowest price relative to earnings or book value. In other words, they're going to appear to be the cheapest. And growth stocks are going to be the ones that appear to be the most expensive. So the key point here is this. Just as we can't look at stocks and bonds straight up in terms of their returns and say, well, stocks had higher returns, they must be better investments. Well, you got to look at risk as well. Well, even within the class of stocks, we have these different characteristics that matter a lot. And so what is fashionable and in fact used in practice all the time these days is to take the entire stock market and force it into this 3x3, what's called the equity style grid. And so we're going to define any stock and commensurately any portfolio of stocks as being either large cap, mid cap, or small cap, and then also as being comprised of either value stocks, blended stocks, or growth stocks. So this 3x3 grid really gives us 9 different cells. And so just as we couldn't compare the performance of stocks and bonds straight up, we also can't really compare the performance of small cap growth portfolios with, say, large cap value. They have very different rhythms, they have different risks, and so they should generate different returns. So as we go through this, we're going to have to concentrate on the idea that we have to look at performance in these different cells as a way of making sure that if we're comparing the performance of two different managers, that we have an apples and apples comparison, that we're looking at people who are trying to do the same thing. And then we have a fighting chance of answering the question, are there superior managers? Now, the reason this chart that we just looked at wouldn't matter at all if the returns over time for each of these cells were exactly the same, or even roughly the same. That tends not to be the case. For those of you who've been through my class, you've seen this chart before. It took me a while to put it together. And so I break it out whenever I can, whether it's relevant or not. But what you're looking at is going back to the 1990s, all the way through this last year. What you're looking at is for each of these 9 styles, you're looking at the returns that they produced. And they're color-coded, and that's kind of what took a while. But you can see the point, I think, pretty plainly, is there's a tremendous rotation from one year to the next as to which investment style, and this is just all stocks, right? This isn't stocks versus bonds versus options. This is just within the stock market, and U.S. stocks at that. And you can see that from one year to the next, what style is in favor amongst investors can change dramatically. You know, if you look, for instance, a few years ago, go back to 2005. And SV, just hopefully the acronyms are straightforward. Small cap value as a strategy was one of the worst. You didn't lose money, but you only earned 5% relative to 2.5 times that if you had been just in mid-cap value names. So you might have said, well, I'm going to avoid that. You know, that's at the bottom of the barrel. Well, that was the best performing class in 2006, almost a 22% return. So if you said, okay, my mission's clear, let's jump on board. Well, the next year, you were in the absolute worst investment you could have been in. And so then you say, well, I've learned my lesson. I'm not going to follow that. So I'm going to avoid that like the plague. Well, you would have missed out on the best asset class in 2008. Now, by the way, best is relative. Best meant you only would have lost about a third of your money. You know, and that would have been, you know, well, it could have been worse. You could have lost over half your money if you'd been in mid-cap growth. So the point is, investment style matters a lot. And that's why if you think about investors who say, oh, I'm invested in the stock market, you know, I have an S&P 500 index fund. Does anybody know what the style of the S&P 500 index fund is? We have a 1 in 9 chance, if you guess. Well, then let me tell you. It's large cap blend, so it's the dark blue. So if the way you think about investing in equity is to just have an investment that mimics the S&P 500, you have this dark blue box, which could be good or could be bad. But what you don't have is a fair representation of the entire stock market. All right, you've missed out on a lot of styles. So a key takeaway, this isn't really what the paper I wanted to talk a bit about tonight is really focusing on explicitly, but a key takeaway for you all today, I think, is that investment style matters, and it matters a lot. And simply picking one cell on that style grid is going to leave you exposed to these tremendous rotations that we see over time. Pick any color and follow the bouncing ball, so to speak. Okay, so what we're asking in this, to talk more specifically about what I wanted to go through a little bit tonight, is we're asking what I think of as a second order question. The first order question would be, does investment style matter in terms of the returns, and we'll see also the risk that gets produced? The answer is overwhelmingly yes. So then a second order question is going to be, and what frames the paper that I came to talk about this evening, is does the consistency with which an investment manager follows his or her mandate, whatever style that they're pronounced to follow, does the consistency with which that manager follow the style, does that matter as well? What you're looking at is a visual summary of two different actual real live mutual funds. And here's our style grid. Again, here's large cap, mid cap, small cap, value, blend, and growth. And what you're looking at is sometimes referred to as a snail trail for, perhaps obvious reasons. It's maybe more obvious on the right even. And so let's think about it this way. Let's say that you were given the assignment to take a look at a mutual fund, a portfolio of stocks, and decide which cell on this grid that mutual fund should go into. Now, how might you go about that? Well, one way would be to look at the actual holdings of the portfolio and just maybe do a histogram or something. How many of them are large cap, how many of them are small cap, and if the preponderance of them, maybe even take a weighted average or something like that of the capitalization, and then you could plot it on this vertical axis. And then similarly, you could look at the PE ratios of the stocks or the price-to-book ratios of the stocks in the portfolio. And if they tended to be lower than high, then they'd be on the value side of things, right? Or growth if the opposite was true. So let's say we took a manager's portfolio, and at the end of every month, we went through that exercise to figure out and position where that portfolio would fall on this grid. And then we do that, say, every month for 2 years. So we're going to have 24 observations over time from way back 2 years ago all the way up till today. All right, everyone with me? And then what I'm going to do is just literally connect the dots on where those points are. So the circles you see of increasing size are just trying to convey the biggest circles are the most recent dots. So it's just trying to give you a sense of where you started and where you are right now. So these are both mutual funds that are large cap value mutual funds. So both of these managers are telling the world, hey, invest with me. My investment style is large cap value. All right, so they have the same style, at least in terms of what they're pronouncing to the world. But clearly, this person on the left is kind of sticking to home a lot more closely than the person on the right. All right, so the styles are the same, but how they go about interpreting their investment mission within that style are fairly radically different here, right? So for the purposes of our purposes in the research, we're going to think of this person as having a more consistent investment style. He or she is staying pretty close to home here. They're sort of to the blend side of value, but they're very large cap. By the way, just you can see where the S&P would plot. I don't know that you can see, that's pretty small. But the S&P would be a very large cap blend fund. This fellow over here, on the other hand, although he's telling you he's large cap value, at any moment in time, he could be, almost to the growth space, or buying much smaller stocks in the mid cap. And does that matter? Well, again, go back to this. Of course it does. If you think you're buying a large cap value manager, and a guy's telling you that's what I'm doing, but what he's really doing is giving you mid-cap growth, you could end up with vastly different performance than you thought. And the punchline is kind of this. If you make a decision and that decision turns out to be wrong, well, what the heck? We'll try again next time. But if you make a decision and it goes awry because someone lied to you. Lied's strong. But someone did something other than what they told you they were going to do. That's kind of on them, and that's a whole different issue. And so this is sometimes referred to style drift. Here is a manager who's telling you my style is large cap value, but he is letting it drift to mid cap. He's letting it drift, toward growth. So think of style drift, if you've heard that term, as kind of the flip side of the coin of style consistency. It's someone who's more inconsistent. So the question of the paper, and I'm giving you more setup than data just because I figure that's probably more interesting to look at pictures like this than look at numbers. But the question that defines our research is all right, we know investment style matters. As a second order question, does the consistency with which managers follow whatever style that they've been mandated, does that matter as well? Said a little more plainly, if we look at the risk-adjusted returns of this guy, are they better, worse, or the same as the risk-adjusted returns of this guy? All right, does this matter at all? The answer is going to be yes, it matters. And what we're going to see is that over time, people who look like this produce far superior risk-adjusted returns than people who look like this. In other words, style consistency matters as well. All right, that's kind of the bottom line of the research. A lot of the rest is details, and so we'll go through until I see the vast majority of eyes glazing over. And then we'll maybe stop for questions. Actually, let me stop here. Are there any? Let's do it that way, because that's kind of the setup and what amounts to the bottom line of what you're going to hear tonight. Are there any questions about anything so far? Yeah, please.
Do you do a statistic? Do you know how statistically significant that variation is?
So that's a great question, because that's exactly what the research part of it is. So if you think about what research amounts to, it's asking a question that people find interesting, and then very methodically answering that in a way that is compelling. And what compelling means in empirical research is making sure you document the statistical significance of any effect you're claiming. So that's kind of the details part. Yeah, that's absolutely what we show in this, and that's kind of the back end of the paper. Please.
Does every investor look for a specific investment style?
Again, that's a great question, and let me go back to the chart. Boy, whenever you say words like every or none, it just seems like the answer to that has to be no. I mean, somebody out there probably doesn't.
Are there a lot of investors?
But there are a lot of investors that care a lot about this, and a lot of advisors. One of the things I do in addition to teaching here is I'm an advisor to the teacher retirement system of Texas, which is they manage about $85 billion. It's the pension fund for the teachers and the dependents of teachers in the state of Texas. Also, I advise the board at UTIMCO, which is the company, the UT Investment Management Company, UTIMCO. That's the university's endowment fund. It's about $20 billion at the current time. At both organizations, I have seen this manager fired. And the point is that when they put together their portfolio, they're going to be diversified across asset classes, stocks, bonds, real estate, and so on. But within asset classes, they also want to be diversified. Why? Well, I just showed you the best reason if we go back to the picture. Because if they load up everything here in the S&P 500, say, and that's what they think of as stock, period, then they're missing a lot. So they're going to diversify across asset classes, but also within asset classes. They want to make sure they have money invested in each one of these cells. All right? So here's the problem. It's a great question. Because if I have hired you as my large cap value manager, and you say, the heck, let's roll the dice and reform the portfolio, and you end up here. So now I already have another large cap blend manager. So you're basically doubling up on what I already own and leaving me a hole in my portfolio here. So even if you're right, and in fact, in one sort of what may seem like an ironic case, I've seen managers who, when they drift away from what they said they were going to do, they actually generate higher returns. But I've seen those managers still get fired. And you might think, well, look, I did better. But the answer is, yeah, but you didn't do what you said you were going to do. And next time you may do worse. And I got to be able to rely on what you said you were going to do for me. So that's sort of a sophisticated investor. And so as we come down the line to people who kind of think of stocks as just the S&P 500, they're undoubtedly not going to be fully covered. All right, so thinking of these second order effects may not be as important to them.
So if I'm a manager and I say that I'm just going to follow the S&P 500 and stay at large cap blend, and if I stay consistent on that, according to your last slide, I'm not going to make the best returns, right? Because
no, you won't. But recognize, and this is again a great question. But I'm going to be, who's my competition? Think about it this way. So if I'm a large cap value manager, who should my performance be compared to?
Other large cap value managers.
All other large cap value managers, perfect, right? So if large cap value goes through one of these cyclical rotations that it does periodically, where it's hitting the bottom, you know, the whole style may stink, but I could still be the best of that set. So it's just all how you define the fishbowl, right? I could still be the biggest fish in there. So that's why, and again, great question, because that's why it's so important when you start thinking about, is this person a superior or inferior manager? You have to look at these issues of investment style. And then the question of this paper is, are people who kind of take, on a more consistent basis, that mandate, do they tend to do better or do they tend to do less well over time? And again, the punchline, just in case that escaped us earlier, is that over time, on a risk-adjusted basis, after we've already taken risk differentials into account and then look at returns, these guys do better than these guys. And not by a little either. It's a pretty wide margin. It's not just splitting hairs statistically. So why might it matter? Let me kind of just run through, quickly a few of these slides. And I'm sorry, other questions before we move on? They're great questions. Okay. So why might it matter? Well, again, and this goes back to the point that was just raised. Managers who let their style drift are far more likely to get fired. And so if you're a mutual fund, what that means is people are going to take their money away from you, and that means funds are going to flow out of your organization rather than into your organization. As a very practical matter, the reason why mutual funds care about that is they get paid a percentage of every dollar they have under management. So if money goes away, that's less money they're going to get paid. All right, so they worry a lot about attracting new business and not losing their existing business. Higher consistency managers, the ones who kind of stay, that guy on the left in the picture before, also tend to, we might surmise that they would tend to have lower turnover. In other words, they're not fussing with their portfolio a lot, selling stocks on a weekly basis. With lower turnover, that means the expenses of running the operation are going to be lower. So less of their return performance is going to be dissipated by paying transaction fees and paying other organizational costs. Trying to chase styles may be a loser's game. Remember the little graphic we went through a second ago. Sorry. That if you looked at small cap value and say, oh, this was terrible, I'm going to stay away. Well, you missed what was the best returning fund the next time. And then if you say, okay, well, now I'm going to jump in, that's the best. Well, now you got the worst. So you say, okay, I'm out. Well, you'll miss the best. You know, I mean, that's the idea. Is that if you don't really know what you're doing, you're just kind of reacting to whatever just happened and setting your strategy accordingly, then that's likely to be a loser's game in the sense you're sort of chasing strategies that have been good but are about to be bad. And then finally, have you heard the term asymmetric information? It's kind of academic speak. It basically means that I know stuff that you don't and vice versa. In other words, information isn't perfect that all of us possess in the same amount in the same way. And one of the things that may differ is if I'm an investment manager, I know I'm really good. You don't know I'm good. So how do I convince you or how do I convey to you what I know about my own talent? Well, one way would be to make it as easy for you to figure out who I am and what I'm all about, right? So again, sorry to keep going back slides. But it's going to be a whole lot easier to figure out what this guy's doing than what this guy's doing. So consistency may be nothing more than my way of signaling to you that I'm good, here I am. You know where to find me. I don't know where this guy is from one period to the next. All right, so he may be searching for he may be good. But it's harder for me to figure that out just kind of by looking at his performance. Okay, so let me go through and give you sort of a taste of the actual research, and we'll get into some of the details. What my colleagues and I did was to look at mutual fund data, which is generally available in computerized form. Return data is generally available on a monthly basis. And we looked at the better part of the last quarter century. We looked at all the mutual funds that kind of fit some of the screening criteria we used in the research. And we made sure that we controlled for these different investment styles. And then we asked the question, are more consistent managers better than less consistent managers? And what does better mean? Well, producing higher returns with less risk would be a good indication of somebody who's better. I'd even put up with a little more risk if the extra return was commensurately more than that, right? So always we have to think about both risk and return in answering that question. Are you superior? Who's better than whom? Right? So let me give you a little taste of the results, and then we'll go through some more details to the extent you're tolerant. So this is over a 25-year period, more or less. And you can see we broke down each of the 9 different cells in the investment style grid. This is just, again, just for stocks now. These aren't bonds or other asset classes, just for public stocks. And I'll define how we went about dividing up each of these different cells into the high consistency and low consistency managers. I'll define that a little more carefully in just a moment. So just take on faith that we were able to do it. And what you see is that the average return over this quarter century is always higher for high consistency managers. That guy on the right in the picture, as opposed to the guy on the left. And in all cases, save one, the risk is actually lower as well. So that's just a slam dunk in terms of deciding that in 8 of the 9 cases, by following whatever your mandate is, whether you want to go for large cap value, smart cap growth, doesn't matter. Whatever it is, you're going to get, on average, higher returns and in almost all cases, lower risk. All right, so that's pretty compelling evidence that there's something here with regard beyond style, the consistency of the style. So there are a couple of other factors that I'll mention, which is that high consistency portfolios, as we thought they might, also have much lower turnover. So for any given investment style, small cap value, it's always the case that the high consistency has less turnover in the portfolio. In other words, they're buying and selling stocks less frequently, which means they're running up fewer transaction costs. And then if we look at that at the expense ratio, which is not only the transaction cost, but all of the operations of running the business, including paying the managers, then what we also see is that these high consistency portfolios also tend to be the ones with the lowest expenses. So it may be, and this is one of the things that when we get into topics of statistical significance, we have to make sure that we're not picking up an effect that is really about something else. But it's, the consistency is correlated with low expenses, and it's really low expenses. So we want to control for other factors that might explain these empirical observations. Okay, so there's lots of people who've looked at this. This is all empirical investment management research. Let me kind of summarize them broadly. First of all, style matters, investment style. You kind of saw a visual of that, that in some sense substitutes for reading all those articles. Also, the persistence of performance is a fairly well-established fact. The markets, unlike what you may have heard or read in some classes, the market tends not to be the flip of a coin. Meaning that if you wanted to figure out who the best manager next year is going to be, what do you think is the most reliable thing you can look at? So we want to figure out for the next, let's say, quarter, who's going to be the best manager? Well, the idea of performance persistence is that the best manager next quarter, this isn't by any means 100% lock, but the best investment manager next quarter is more likely than not going to be the best investment manager this past quarter or the quarter before that. In other words, if there's really talent at work here, good managers are going to win out over time. So one of the things we have to do in looking at this consistency effect that we're arguing for is to also ask the question, what about the persistence? Are we just picking up managers that tend to be the best managers over time, and it's about something else? And then finally, investment style drift, and we've talked a bit about that. Okay, so let me get to a few kind of summary things, and then by the way, are there any more questions? Rather than just putting them all off, if you have them as we go along, why don't we handle them like that? And then we'll just go to the top of the hour. Okay, very good. So now how do we measure investment style consistency? Again, the picture we have is fairly dramatic in terms of that one on the left. There's clearly something going on that's different than the one on the right. So how do we capture that statistically? How do we put a number to it? There are two general approaches in finance that we can use. One is to look at the actual holdings of a portfolio. So a mutual fund may have as many as 200 different stocks in it. And so fairly recently, what we've started doing as a research mission in finance is actually cataloging what the holdings are for mutual funds. The actual stocks and how much of each stock they own. So with that data, it's beautiful because we can tell from one period to the other, we can figure out what the manager's done. They had IBM in June. They don't have IBM in September. What does that tell us? Well, IBM's still around, right? So it means they sold their IBM position. So we know what decisions they actually made. The problem with trying to focus on holdings, so I would argue that's probably the best way to think about this. Because we can, by looking at the holdings, we can figure out what the manager actually did. The problem is, for most big institutional investors, we as outside investors will never see what their holdings are. Hedge funds are notorious for not telling people what they actually own. In fact, hedge funds often don't even tell their own investors what they own. You know, investors sign a contract when they put money with a hedge fund manager often that says, we're not going to tell you what we're buying on your behalf. You know, that's how secretive it can be. Mutual funds aren't like that. They do report what their holdings are, but they only report them on a quarterly basis. So what that fund did between June and September, we don't know. They could have bought and sold IBM 5 times in that stretch. All we know is where they were in June and where they are in September. So there are some practical limitations to looking at anything, and consistency in particular, looking at the holdings of the portfolio. So then the other way to do that is to really look at a fingerprint of what the manager did, which is to look at the returns that the portfolio generates. We can infer what must have happened, but we don't actually know what the decisions were. So the advantage of looking at returns is we have daily observations on returns. So we have a lot more data, but it's a fuzzier, kind of muddier number in terms of really understanding the decisions that were made by the manager to generate those returns. All right, so let me talk a bit about the measures and show you some data. The first measure of consistency we use is going to be, we'll specify a factor model and run a regression. So factor model, again, this is where I start glazing over. Think of this as maybe the CAPM. So then what we're saying is, how much of the returns for this mutual fund managers are explained by the CAPM? Or by a multi-factor model which includes different investment styles. So whatever isn't explained is going to fall beyond the bounds of what the investment style was. So the coefficient of determination, or R-squared, for those of you who've had your stats or care to admit that at this point, is going to be our first measure. The higher the R-squared, the more consistent the manager is with regard to that particular style. Holdings is going to be a little bit thornier. We actually had to create this measure ourselves. And what we did was look at, for every mutual fund in our sample, we looked at all their holdings, and we looked at how they changed over time. But instead of just looking at IBM, what we did was we translated IBM into where it would fit on that style grid. Is it a value stock? Is it a growth stock? Is it large cap? Is it small cap? In fact, we also used a third style factor, which is momentum. You know, has its price been going up or been going down, which has become popular. And then what we did was we created a portfolio-wide score based on all the holdings in the portfolio, and then saw how that changed over time. So our holdings measure is basically going to be the equivalent of a standard deviation, which looks at how the characteristics of the portfolio change over time. Does that make sense? I mean, don't worry. I don't think there's a quiz. I'm not giving you one anyway. Maybe. So here will be. But you know, just kind of get the sense of what we're looking at is we're looking at the holdings, and you could own IBM, and you could sell IBM. But if you sold IBM and bought Dell, then the style of the portfolio may not change at all, right? In other words, if I buy something that looks enough like what I sold, it may not alter the style. Everyone sees? So what we had to do is translate each stock into what its style would be, and then look at how styles changed over time as the portfolio was revised. All right, so going back to this picture, then the higher the R-squared, the more consistent. That's the returns-based measure. And the lower this holdings-based consistency, because remember it's a standard deviation, which the higher the standard deviation, the more dispersion, or the more drift there is, right? So a lower number here indicates, for the holdings measure, indicates more consistent performance. So as I mentioned, these aren't made-up pictures. These are actual managers. And you can see the numbers associated with what we're calling a high consistent and a low consistency manager. All right, so let me run through some of these fairly fast. We actually, so that was our research question. And then going back to the point that was raised earlier about the statistical side of things, what you do is you translate, when you're doing research, your research question, which is, does investment style consistency matter? Well, that's a little vague, so we got to be more precise. And so we came up with 3 different hypotheses that we tested. You know, the most important is really the last 2. The most important are the last 2, which is, if you have higher consistency, do you produce better risk-adjusted returns? And then finally, is the consistency effect, assuming it's there, is it distinct from this performance persistence effect? You know, can we differentiate between the two? Do they both add to the debate? And the answer is yes and yes. I'd be talking about something else if those answers weren't yes and yes. So I won't go through in great detail the methodology. Again, we looked at thousands of mutual funds over a 25-year period. And what we're trying to do is to say, if we know the consistency of the portfolio now, does that help us understand better the returns it's going to produce in the next period? And so there are many details. The answer turns out again to be yes, that the most consistent funds now are the ones that produce the highest risk-adjusted returns in the future. And by future, we looked at 3 different visions of the future: the next month, the next 3 months, or the next year. And the answer doesn't change. You know, the best predictability was over the next quarter, the next 3 months. But the punchline is the same no matter how far off into the future we try to predict it out to a year. And then finally, what we also show is that the performance persistence effect and the style consistency effect are indeed distinct, and they both add to the explanation. So this isn't just mimicking something else that we already know. And then, so that, let me go back to the point that was raised a second ago about statistical significance. Be careful with the word significance as you kind of go through your programs and your lives, because that can mean different things to different people. What statistical significance means is that we have probability distributions that we can invoke, and we have statistics that will differentiate between 2 different causes of something, you know, cause A and cause B. Or maybe we're looking at outcome A and outcome B. But we can take 2 different numbers, and we may end up with returns. Let me give you an example. Let's say we have 2 portfolios, and on a risk-adjusted basis, portfolio 1 generates a risk-adjusted return of 0.200, and portfolio 2 generates a risk-adjusted return of 0.205. If we have enough observations, the difference between 0.200 and 0.205 could be statistically significant. But is it economically meaningful? What if that ends up being the equivalent of 2 cents for every $100,000 you invest? You see my point? I'm kind of making it exaggerated here. But we can have statistical significance without it really being economically meaningful. So the back end of this paper, and I suspect we won't have time in the next few minutes to get there, demonstrates that not only are these consistency effects statistically significant, but they also lead to economically meaningful outcomes. That we can think about it as increasing the probability that we'll be able to pick next month's superior manager by looking at the one that's the most consistent this month. And we also show in the paper how that leads to actual dollars and cents performance that's measurably different from being inconsistent to consistent. So the data I've talked a little bit about, here's again, we end up with close to 2,000 mutual funds over this 25-year period, scattered throughout the different style cells. And our consistency measures, whether they're based on returns or holdings, agree with each other. So we're saying here are two ways to think about consistency. If they didn't tell us the same thing, we'd kind of be in trouble. Well, one or the other would be wrong, or maybe there's no merit. But they give us largely the same indication. So we're comfortable that we're capturing the idea. And so let me just kind of summarize, and I'll end after this, by showing you what we did. For each mutual fund at any point in time, let's say we're looking at, just to pick a month, let's say June of 1997. We looked at the prior 36 months worth of data. And that allowed us to evaluate style consistency, using the statistical measures we talked about. It also allowed us to look at what the risk-adjusted return performance was over this period. And then the question we ask is, if we know all that, so here we are at this point in time, we know everything that's gone on up until now, the manager's past performance, whether they're consistent or inconsistent, we know their expense ratios, their assets under management, all that stuff. Does that help us predict what's going to happen over the next, say, 3 months? So that's ultimately what the experiment is. And so just to give you a taste of the way we went about it is, in order to calculate past performance, we looked at the difference between the return the manager generated and what she should have generated according to expected returns. And what we used were several different versions of a factor model which accounts for the different style effects. Okay, again, I don't know where you all are in the program. Have you seen these multi-factor models, the Fama-French models? Well, you have a great treat in front of you if you haven't seen them yet. But basically, think about it this way. This is the CAP-M with some extra stuff tacked on that accounts for investment style. This is the size factor. This is the value growth factor, for instance. And so I'll just kind of summarize with this chart. I think we'll make the point, which is we run a regression, and this is now the statistical significance part, and we use as our dependent variable the return, the risk-adjusted return over the next 3 months. And we try to explain that by looking at a series of variables over the prior 36 months. So in research parlance, this is called an out-of-sample design. So we're looking at information we have available now and trying to predict something that's outside the sample we used to estimate the data now, right? So we're trying to predict the future here. And just, I've kind of circled the key points where whether we define consistency with the returns or with looking at the holdings, it's always the case that next period's risk-adjusted returns are significantly connected to last period's risk-adjusted returns, as well as this consistency measure. So they both matter, and they are distinct. They are distinct. And no matter what you throw in there on top of that, like expense ratios and turnover, that doesn't change the significance. So these are real effects, and they matter. And so let me kind of go through. The rest is just sort of looking at some other cuts of the data. And basically, I'll just kind of summarize with this. If you did nothing more than pick high consistency managers versus low consistency managers, you're going to outperform on a risk-adjusted basis by 108 basis points. Which is to say that if you pick low consistency managers in whatever style, I pick high consistency managers, your average return is going to be 11.4, mine's going to be 12.4. over time. So that's real money. That's real money. This is the economic significance of it. So just to wrap up, and we're right at about an hour from when we started, so it's be good to get to our conclusions. Regardless of the investment style, this idea of having managers that stay truer to that mandate or more consistent appears to matter, both economically as well as statistically. Style consistency is a separate effect from just having a manager who performed well in the past, what we call performance persistence. So they both matter. But the key point, I guess, from our standpoint with this research is that style consistency is not subsumed within this idea of performance persistence. They are distinct, and they both matter a lot. And that beyond the statistical stuff, anytime you have thousands of observations, you might get statistical significance, but we've also indicated that there's a fair degree of economic significance in this as well. This is a tool that'll help you identify those better managers. It'll also help you as an investment strategy to outperform other people who ignore it. Okay, so any other questions? Well, thank you very much for your attention. I hope you enjoyed dinner or appetizer.